We keep saying that the US market is always better than the Canadian one, but can individual Canadian stock beat their equivalent on the US market?
Fellow investors, bonjour. This is Mike Leroux, founder of Dividend Stocks Rocks and passionate investor. You're listening to the Dividend Guy blog podcast where I and my co-host Véronique will help you invest with more conviction so you can enjoy your retirement.
Dividend Growth Investors, bonjour. Mike Leroux here. You're listening to the Dividend Guy podcast. And today we have a different version of our stock battle. And I'm with my co-host Vero. That brought in that idea. And I think we're going to have a lot of fun today. How are you doing, Vero?
I'm doing good, Mike. And today's episode has been inspired by questions we received from DSR members or webinar attendees about the importance for Canadians to invest on the US markets and the value US investors can get by putting some money on the Canadian market. So we believe the best way to show this is to use stock battles.
Yeah, so we're going to take companies that are, of course, in the same sectors, but have also similar business model, which is not always the case. And, I'm a big fan of the US market because there's a lot of companies that just simply do not exist on the Canadian side. But this stock battle will open the eyes of a lot of investors, I think, because even while I was preparing my notes, even for some of them, I was even surprised. I'm like, wow, that's actually a no-brainer, and there's a clear winner here. And spoiler alert, not always on the US side.
So, Mike, we all know your love for Canadian banks because those structure often makes them better options than US ones. But let's see what happens if we put two classics head-to-head, Royal Bank versus JP Morgan Chase, JPM. Let's describe their business model.
So first, I just want to start one step behind where the reason why, in general, Canadian banks are better than the US ones is in Canada, there are more regulations, and you cannot simply just open a bank on the corner of a street because you have money in a business model. So while there are thousands of banks in the US, I think there's 30 something licensed bank in Canada. And let's be honest, there's the big five, and I like to add National Bank to the mix. So we're talking about 6 banks controlling most of the banking services in the country, while in the US is really the far west where everybody can open a bank at any time. So of course, with those regulations, the fact it's an oligopoly, it makes it easier to be profitable and be stable if you're on the Canadian side. So for Royal Bank, what makes it different than other banks? Because since 2008, banks have been taking different growth vectors, different strategies to grow, and Royal Bank went the route of diversification. So today we have roughly 50% of the bank revenue coming from personal and commercial banking. So those are the classic activities, the mortgage, the loans, the commercial loans, and so on. But then they have 28% coming from capital markets, and then 14% from wealth management, and the rest is coming from insurance. So this is one thing I really like about Royal Bank is while they are mostly making money in Canada with 61% of their revenue, they have a good diversification across different business segments, but also with 27% in the US and 12% international. So it's a great mix of type of business segments, type of geography, and the revenue, the revenue streams enables Royal Bank that if we have a housing crisis, they will still be able to have some business units that will continue to work well. In comparison, before I switch over to JP Morgan, Royal Bank has a market capitalization of around $210 billion. When we look at JP Morgan, of course, it is a behemoth. We're talking about almost 600 billions of market capitalization, so definitely bigger than Royal Bank. However, their business model is a bit similar, where the bulk of their money is coming from either consumer and community banking, so similar to Royal Bank when you have like and that includes like home lending, card services, auto financing, banking, and also wealth management. The difference after that is they also make a lot of money from commercial and investment banks. So it's almost like 45% consumer and community banking, 45% commercial and investment banking, and then the rest is asset and wealth management. So a great business model, well diversified, a little bit more tied to investment banking than Royal Bank, but still we have two businesses that are quite comparable, if not that Royal Bank is smaller than JP Morgan, of course.
Mhm. Now, looking at the revenue, EPS, and dividend growth metrics for the past 5 years, JP offers more growth. Do you come to the same conclusion looking at the trends, Mike?
When you look at the dividend triangle, and this is one thing that I've used to make this exercise, is I went on Dividend Stocks Rock and I compared both dividend triangle, not just the numbers, but rather the trend. What I can see from JP Morgan is it's a little bit more hectic. So there are periods of very strong growth as we have right now, and some other period that have like bigger slowdown than Royal Bank. That could be explained as well because Royal Bank, most of their business is in Canada,
Mhm.
oligopoly, very stable. So that's a reason why it happens. But as of late, JP Morgan shows more revenue growth, more earnings growth, and more dividend growth. However, it is more possible you have like higher chances to see the dividend being stopped at one point, not necessarily being cut, which actually happened in the past, but not only just the dividend cut, but also a like pause in the dividend growth. For Royal Bank, the only way that it had happened is when, unfortunately, regulators said, well, we're going to back up all the loans during the COVID, but it's not true that you're going to be able to increase your dividend during that time. So, unfortunately, we had a time in between 2020 and 2021 where the bank could afford to make a dividend increase, but it was
Mhm.
stopped from regulators. But if not, definitely Royal Bank shows because of its more stable business model, a better dividend growth profile. But JP Morgan shows a lot more growth vectors here.
Okay, so while Royal Bank offers a better yield, JP Morgan shows a more stable payout ratio and an attractive PE ratio. Does this give GPM an advantage?
Yeah, definitely. I think that at this point, if you're looking for a company that goes a little bit more on the growth side, JP Morgan could be quite attractive. In terms of the PE ratio, it's kind of interesting because the current PE and the forward PE is slightly below 12 for JP Morgan. Well, Royal Bank is at 12 times its earnings, so slightly higher than GPM. So for a company that, for a bank that offers a higher potential growth and trades at a lower multiple, I would be tempted to take a look at JP Morgan a little bit more, especially when you look at the dividend growth rate over the past 5 years. We have something very stable for Royal Bank at 7 for the past 5 years. 7 also for the past 3 years, and 4.55 the last 12 months, while JP Morgan is the opposite, where the last 12 months shows a 15% increase, and over the past 5 years, we are at 8.5%. So a little bit more growth as of late. Again, that explains because they show stronger revenue growth and stronger earnings than Royal Bank at this stage. So while you do have a smaller yield for GPM, it seems that there's an interesting deal happening here.
But then, how do you explain that RBC has slightly better ratings at Dividend Stocks Rock than GPM?
I got caught here. Jokes aside, I mean, both of them have great ratings, but RBC shows a DSR per rating of 5 as opposed to JP Morgan at 4. So both are buys according to our standard. But the reason why I decided to maintain ROI slightly better rated than GPM is for its overall longevity. So the fact that the business is more stable, and if we like right now, if you look at the past 5 years, of course, GPM looks a little bit better. But if you look at what happened in 2008, nobody would have preferred to have GPM over Royal Bank in their portfolio. So it's just a matter of like which one is better equipped for growth versus which one is better equipped for a recession. And I think that Royal Bank is slightly better equipped for the recession.
All right, so in the end, who's the winner? RY or JPM?
For this one, I have to call a draw. So I'm going to be like a bad referee and I'm not going to make a call. I would say that both companies are great. I love their diversification. I love their growth vectors. So if you're Canadian, I would go for Royal Bank. If you're American, I would go for JP Morgan. And if you're looking for a second bank in the different country, well, then you have your winner. But overall, I think you cannot really go wrong with any of those. So we're going to start smoothly this episode with a draw, making everybody happy before I start to ruff some feathers.
So the industrial sector is a good one for finding contenders in both markets. Our next battle is between two railroads, Canadian National Railway, CNR.TO or CNI on the US market, and Union Pacific, UNP. How would you describe them, Mike?
Well, of course, two railroads, so business model pretty
Yeah.
similar. When you look at the railroad industry in North America, we really have like four large company that is worth talking about. So on the Canadian side, you have Canadian Pacific, CP, and Canadian National Railway, which we're going to talk about today. On the US side, we have CSX and we have Union Pacific, which are two major railroad operators. So for CNR, let's start on the Canadian side. We're talking about close to $100 million of market capitalization, with railroads going from all the way to the Western Canada to Eastern, so coast to coast in Canada, and also deserving a big portion of the US, going all the way down to the Gulf of Mexico. So, and all the most of the railroads starts around the Great Lakes and they go down south. So
Mhm.
a very solid railroad asset here. They do serve several different industries. So we have among the largest one, we have petroleum and chemicals at around 19%. We have grain and fertilizer. We have forest products, metal and minerals, automotive, domestic intermodal, international intermodal, and coal at 6%. So wide variety. A lot of them are like between 12 to 20% of their business, which also ensures that if there's a slowdown in grain and fertilizers, while maybe automotive or intermodal are going to pick up
Mhm.
some transportation volume or vice versa. So that makes them a well diversified, well established company. And of course, railroads, they have like one of the best business model because it's almost impossible to replicate. It would cost definitely way too much to start a new railroad network today. Now moving on to Union Pacific, slightly bigger, so 150 billion in market cap. In this one, we do have also a business serving different industries. So we have coal, grain, we have rock, petroleum, petrochemicals, intermodal as well, so international and domestic, and also automotive. Union Pacific is its network goes all across the U.S. So they serve like more cities and a larger network on the US side, but not present in Canada. And the other thing is they transport more coal than CNR. So those are like the major difference, but definitely two leading railroad company, one in Canada and the other one in the US.
So, Mike, when I used the DSR stock comparison tool for these two, I didn't see much difference between the yields and also the payout ratios. However, CNR's dividend triangle looks a lot better than UNP's, right?
Yeah, so the way I do all my stock battles when I do private webinars for my members at DSR is that I will go into the stock comparison tool as you mentioned, because what I like about this is you can key in all the stocks in the same industry and then start comparing numbers. So regardless of what you think or what you believe, You put the narrative aside and you just look at the hard fact. And at first, as you said, not that much difference on many metrics. So it seems like we have like both winners. But there's the numbers and there's the graph, the trends, and the trends will tell us a different story. So when I started to look at Union Pacific dividend triangle, this is where I saw something that is definitely less stable and less going towards growth than CNR. So first, when you look at the revenue, it goes up, it goes down a lot more. Like the variation are more important than CNR, and that also is being reflected in the earnings, which kind of makes sense because railroad operators usually they will maintain about the same cost of operating. So if they have more transport, well, they will also make more money, and if their transportation volume goes down, their earnings will also follow. So more hectic in like from one year to another, and that left UNP with some period of time where they do not increase their dividend. So they announced as a like recently in August a dividend increase, but that was the first one since 2022. So it was
Mm-hmm.
about time they increased their dividend
Right.
because if not, we had a pause during the pandemic, which I'm willing to forgive because that happened for a lot of companies and we know why. But in 2022, they raised once and then nothing in 23, and now we're like 8 months in 2024, and finally we got the another race, and it was like a small one. So again, not super interesting on that side. So when you look at the numbers, you look at the trend, you can see that the CNR will show better metrics. Of course, they show a similar yield, and in terms of the P ratio, CNR trades at 18 times its earning. UNP trades at 20 times its earning. So I would be willing to say that maybe there's a small deal on CNR to be made at this point. I like to say that whenever you see Canadian Natural Railway offering a yield above 2%, you usually get a good deal. Right now, we're at like 2.2%. So probably that it could be something interesting to look into.
By the way, listeners, we've mentioned DSR a couple of times already in this episode. So, DSR stands for Dividend Stocks Rock, our membership website that you can visit at dividendstocksrock.com. So, Mike, which one is winning here and why?
Well, I would say Canadian National Railway by far, mostly because the dividend triangle is more stable. So we have on the financial metrics side, clearly an advantage for CNR versus Union Pacific. And in doubt, I will always go for the strongest dividend grower, which is obviously CNR in this
Mhm.
case. The other thing I like is the fact that CNR is present in both countries, where it's more difficult for UNP, where it's just in the US, and the fact that they have like more coal transportation than we have in CNR. We already know that coal is probably not going to thrive. It's not an industry that is going to thrive in the coming years. So while it is still going to be part of the economic environment, it's probably going to continue to slow down. So for those two reasons, and mostly the numbers are talking here, Canadian National Railway, which is a good thing because it trades on both markets. So CNI or CNR.TO on the Canadian one, definitely CNR by far.
Hey, dividend growth investors, this is Vero. Mike is currently taking a sip of water, which gives us 10 seconds, and I literally mean 10 seconds to grow the podcast together. Go on Spotify or Apple Podcast, hit pause, and then under our logo, you'll see two very interesting buttons. One to subscribe, hit that subscribe button now, and then give us a 5-star rating. Our goal is to help more investors just like you, so please spread the love. Thank you. Okay, so moving on to the utilities with two companies that show excellent ratings of 4 at Dividend Stocks Rock. However, Nextera Energy NEE and Brookfield Renewable BEPC or BEP are not in the same industry. So what else describes them?
Yeah, so NextEra Energy, a behemoth of the energy sector, not the energy sector, but the utility sector. It has multiple companies, but most of its revenue is coming from Florida Power and Light Company, FPL. So for FPL in 2023, we had 73% of their energy mix coming from natural gas, 20% from nuclear, 6% from solar, and 1% from other sources. So mostly a natural gas linked utility.
Mhm.
Flourishing in Florida, so being in one of like the richest and most thriving state in the US, definitely provide them a strong advantage. On the other side, we do have Brookfield Renewable. That's still not too small, with about $100 billion in assets under management. But this one is all about, you guessed it, renewable energy. So
Mhm.
47% on hydroelectricity. Then we have utility, we have solar, and we have wind. We also have like sustainable solutions that they are offering, and some distributed energy and storage. So half of it is hydroelectricity. Most of the rest of it is like wind and solar, and some storage and distribution on the side. They are present across many countries. So 61% of their assets are in North America, but we have 17 in Europe. We have 18 in South America, and a small portion of 4% in Asia. So better diversified worldwide, a big focus on hydro, wind, and solar energy, as opposed to the other one, which is mostly nuclear and natural gas.
Mike, I'm having a hard time coming to a conclusion after looking at the revenue, EPS, and dividend trends for both utilities. BEP has a stronger revenue trend, but NEE shows better EPS. Both have like great dividend growth trends. So, what's your take on this?
When you're having a hard time analyzing numbers, it's probably because that specific industry or company is not necessarily using those numbers that you want to look at. So this
Mm-hmm.
is a great example, and I'm glad that we had this one to highlight this. A lot of investors will go from like classic financial metrics. Like on my side, of course, I focus on the dividend triangle, which is revenue, earnings per share, and dividend. But some others could look at cash flow. Some others could look at payout ratio, for example, or PE ratio. But when you have numbers that don't really make sense, or they're quite hectic, then it's time to do some more digging, especially for utilities, which is one of the type of business model that are quite capital intensive. So we're talking about companies spending billions every year. So sometimes if you look at the free cash flow, for example, those numbers are going to be completely out of whack, because
Mm-hmm.
the free cash flow will show how much those companies are generating in cash flow. But if they have spent a large amount in capital expenditure, it will not include the debt that they brought in as well to finance those projects. So they will show sometimes negative cash payout ratios, negative free cash flow. So you may be thinking, well, I don't want to invest in a business that is losing money and it's
Mm-hmm.
burning its cash flow. That doesn't make any sense. So for those, unfortunately, the dividend triangle, not that useful. You have to look and do more digging. What I like to do in those cases is to go directly in the company's investors website and start looking at their press release for the quarterly earnings and their investors presentation. From there, you will see on what they focus on. So for Brookfield, for example, they will explain how they calculate funds from operation, and they will also provide funds from operation per unit or per share. So it's the kind of like a little bit of an equivalent of the earnings per share, where you can see how much funds per share is being generated by this company. Of course, what you're looking here, what you want is to see some growth. So between 2016 and 2023, we had a FFO per unit annualized growth rate of 12% for Brookfield Renewable, and between 2001 all the way up to the end of 2024, what they expect, they will also offer a 6% distribution per unit growth.
Mm-hmm.
So This business grows its FFO double digit, but it also grows its dividend high single digit. This is the type of metrics that I like to see because yeah, we can debate if FFO is kind of like a homemade calculation from the company, and then there are like various ways to calculate it. That's why it's not recognized as a GAAP number, but rather as a kind of like a homemade metric. But you cannot really fake higher distribution because that's
Right.
real money getting out of Brookfield's bank account every quarter. So the fact that they've been able to increase it year after year at 6% annualized growth rate, that tells me a lot. On the other side, when we look at Nexera Energy presentation, we'll see that they focus on earnings per share, which is great because it makes our life a lot easier to look at. And they expect to grow their earnings per share between 23 all the way to 2027 by 6 to 8%. So we can see that we have some kind of like a similar dividend growth rate, not dividend growth rate, but earnings per share or FFO rate going forward for both companies. Of course, they use like a similar way in terms of business model where both companies spend a lot of monies on future projects. They expect to be able to charge a higher rate for their energy and to get more customers. And this is how they expect to increase either funds from operation or earnings per share. Of course, Nexera Energy, a little bit easier to follow because you focus on the EPS instead of going with a FFO, which is not less trustable, but less standardized, if I would put it that way. So I would have like a small preference for Nexera Energy in terms of their accounting. We already know that Brookfield, also one of their largest risk from their business model is their opaqueness in their financial statements. So that could lead to a small advantage at this point of the analysis for Nexera Energy.
Okay, so now BEP has a very attractive yield for income seeking investors. It also seems to show a better entry point than NEE. However, Mike, we have to consider debt levels for these capital intensive businesses. So, do you have any thoughts on this?
Yeah, whenever we talk about capital intensive businesses, well, we have to talk about debt. A good way to classify the debt is to look at their investment ratings. So NEE is a A minus, while BEP is a triple B plus. So slightly worse or under than the A minus. So it's like one grade lower for Brookfield Renewable versus Nextera Energy. I'd say that both of them shows strong balance sheet, but definitely Nextera Energy again is slightly better in terms of numbers than Brookfield at this point.
So, in the end, which one is the winner, NEE or BEP?
I'm once again I'm having a bit of difficulties here, mostly because what I like about Nextera Energy is they have cleaner numbers, slightly better as well. But I don't like the fact that they're kind of like limited mostly to Florida, instead of like Brookfield that operates across the world, a little bit more towards renewable energy with their hydroelectricity solutions. But I don't like the opaqueness of Brookfield Renewable. So it kind of like a tie depending on what you want in your portfolio. So if you don't want to have like to worry about it too much, probably that Nextera Energy is your go-to. If you're willing to take a little bit more risk, but you like the fact that you have like a better diversification, Brookfield could be an interesting play. Overall, if I really have to pick one, I might go for Nextera Energy, though, after looking at the numbers. I think the numbers is always a little bit more important than the narrative. But ironically, I do have Brookfield Renewable in my portfolio and not in Nextera Energy. So that's kind of funny.
That's what I was about to say. I was like, Mike, why do you pick NEE if you have BEPC in your portfolio? But I mean, it's okay.
Well, I mean, at that time when I bought it, I saw a better opportunity because Brookfield Renewable doesn't get much love. So I see that
Right.
the upside potential is probably a little bit better. I don't mind having a higher level level of risk either. So for those two reasons, I personally picked Brookfield Renewable. But in general, I think probably that people could be better with Nextera Energy.
And by the way, US American listeners, all the stocks we've mentioned so far on the Canadian side also trade on the US market. So BEP is BEP or BEPC, CNR, and RY, of course. But it's not the case for the last one. And I've been waiting for that last stock battle since we started discussing the episode, Mike. We will put your beloved and dearest convenience store to the test, the one that you've been mentioning every episode. So the battle is on between Alimentation Couche-Tard, ATD.TO, and CASY's General Stores. Ticker is CASY, but CASY. First, let's see the differences between their business models.
Yeah, so unfortunately, if you want to buy Couche-Tard on the US side, you will have to buy it over the counter as a pink sheet. So the ticker is ANCTF. ANCTF. Of course, a lot smaller trading volume on this one if you're American. So you might be scared a little bit or might be concerned, but yet Couche-Tard has a market capitalization of 77 billion. So it's not a small company. It's just for some kind of weird reason, it's just not trading on the US side. And I wonder why, mostly because most of their revenues are coming from the US anyway. That's kind of ironic. They are operating convenience stores. They have close to 17,000 stores across the world, operating in 29 countries. So definitely a well-diversified business. They recently made the acquisition of like 22 or 2,300 stores in Europe from Total Energies, expanding their presence in Europe at that point. So I've discussed so much about Alimentation Couche-Tard. I thought of like going to CASY stores right away instead. So CASY's CASY market cap at almost 14 billion. So definitely like about 1/3, so a lot smaller than Couche-Tard. In the Midwest, targeting small population in the US. So it's kind of like completely a different business model at this point. 2,600 stores, so definitely a lot smaller. However, it's quite interesting to see that they operate the third largest convenience store chain in the US, assuming that Couche-Tard is probably second, and then 7-Eleven is probably the first one. Fourth in liquor licenses among U.S. retailers. And fifth, I mean, that one surprised me. Fifth largest pizza chain in the U.S. So they're selling a lot of pizza in their convenience stores. I was like, really? How could that be? Like, I was like quite surprised. But that's their business model. I really like the fact that they are heavily concentrated in the Midwest, and then they decided to add different types of product into their store, notably prepared food, which is definitely a great growth vector for them. And they probably know a little bit more about their market, since they're more niche than what we have at Couche-Tard. Another thing that is interesting is they own their own distribution center, so they are trying to be vertically integrated to ensure that they're, of course, making a little bit more profit at each step of the way. I really like that business model. Seems that they kind of like grab a few pages of Alimentation Couche-Tard playbook, and they've done pretty well so far.
Listeners, let's empower you in the investment world with our free dividend rockstar list, which includes stock ideas with positive dividend triangles. How does the list help investors, Mike?
You know, Vero, we survey regularly our members and our readers, and we ask them what are their biggest struggle. And one that keeps coming back is really the buy struggle. Most investors don't know what to buy, they don't know when to buy it, and the Rockstar list will help them grow a little bit more their conviction, because that list of stock will just include companies that show great financial metrics. Of course, you cannot start by picking them blindly, but it's a pretty good start to make sure that the company that you're about to read and know their business model is actually a business showing revenue growth, earnings growth, and dividend growth. The way I use it usually is I will filter it by sector to identify a sector that I want to have more exposure to, and then I just look for companies that have the strongest dividend growth model.
To download the list, enter your name and email at thedividendguyblog.com/rockstar. Again, hit pause now and go to thedividendguyblog.com/rockstar. Okay, and I must admit, Mike, I was quite surprised too, looking at both dividend triangles. So CASY shows higher revenue and EPS growth. Its dividend growth is also very impressive. So my question, and it's a hard one, is CASY the next ATD, Mike?
Yeah, pretty good question. And I mean, I was a bit bummed to see that there's another convenience store showing better metrics than Couche-Tard over the past 5 years. Total revenue growth in the past 5 years was 59% for CASY, 23 for Couche-Tard. EPS growth, not annualized growth rate, total growth, not annualized, to make sure. EPS up 112 for CASY, 61 for Couche-Tard. At least for the dividend side, Couche-Tard shows 180% dividend growth, but CASY is not too bad at 56%. And in terms of the stock price, even though CASY has been up 123% over the past 5 years, while Alimentation Couche-Tard was up 94. So small advantage everywhere besides the dividend. So yeah, that could be a good question. But here's the thing. Since CASY is a lot smaller, yes, they kind of like replicated a little bit the business model of Couche-Tard. It is still a highly fragmented market, the market of convenience stores in the US. So there are like plenty of room to open more stores. And the main difference, which I think worked very well for CASY, but it's definitely less scalable going forward, is they went for like smaller population, going for like being the only place where you can buy something in a village where ATD is present everywhere. That reminds me a little bit of the Tractor Supply business model, where they focused on rural, less populated, but a specific niche market for their stores. CASY has a similar business model for a good part of where they are. So they have been able to show better numbers in the past few years, especially in 24 so far versus ATD that has been struggling a bit this year to generate some growth in the revenue and earnings. But overall, it's all about the size and scale. It's a lot easier to grow when you operate 2,600 stores than when you open close to 17,000.
And we've discussed more about Tractor Supply in the 10 amazing dividend growers episode that you can retrieve at thedividendguyblog.com/187. So, Mike, what conclusion can you make in terms of risks and valuation?
So in terms of valuation, we have Couche-Tard trading at a PE ratio around 19 to 21 times its earning, which is pretty much aligned to what it has been traded for the past like 10 years. So here you're not getting a great deal, but you're pretty much buying a growing business still valued at a decent, as a fair level. For CASY, the PE ratio right now is around 26 to 27 times the earnings. So, of course, we expect more growth from CASY than from Couche-Tard. As I explained earlier, a little bit easier for CASY's to grow at this point versus ATD that has become like a major player. And if Couche-Tard is buying like 200 new stores, not going to make any difference in their business model, while CASY, that would be almost 10% of all the stores that they have. So that could be like where you have a little bit of a difference. In terms of risk, they operate a similar business model, but CASY still is very concentrated in the Midwest, while ATD is global. I think that as a scalable business, ATD has a better business model because they have been able to run through more different challenges just by the fact that they have been operating in multiple countries than where CASY, they know their game, they know their playbook, they are really good at the game they play, but it's a smaller game in my opinion.
Mhm. So, all things considered, is ATD winning the battle? And second question, is it time to add CASY to our DSR database, Mike?
Well, I'd say I'm completely biased here, so my opinion is probably not worth much, but definitely I'm going to give the big win to Alimentation-Couche-Tard. However, I was really surprised when I dug into the numbers of CASY, and yes, that could be a great candidate to be added to our DSR database. I'm pretty sure I'm going to make some investor pretty happy when they will hear about that. As you know, we're trying to cover as many stocks as possible at DSR, but we cannot cover them all. So for all the stocks that shows a yield under 1%, we go either for companies that have a very interesting business case or those that are quite popular. Of course, CASY, not that popular, but definitely the business case is quite interesting. And when we look at how the stock price grew over the past, like this year, especially in 24, that could be quite interesting to start following this one a little bit closer going forward.
Mhm. So, before we end the episode, would you like to add some thoughts about these Canadian versus US battles and all the questions we keep receiving?
Well, I think it was a very interesting way to compare two different types of companies, mostly because while they operate similar business model, they have major differences, especially in their geography diversification. I think it's always important when you do those kind of like battles or comparison tools to add context. So whenever you see numbers that don't make any sense, dig a little bit further instead of just saying, oh, there's like very bad numbers here, I'm not investing. Well, ask yourself questions like why the numbers don't make sense. And if you cannot find the answer, probably that digging into the company's investors website will give you those type of answers. In the end, if you cannot find them, just skip it. I mean, it's not worth it to invest in a stock that you know just half of the story because you have like unanswered questions. And if you just cannot make sense of your investment, there's no point of putting money on this one. There are so many great opportunities out there that you might as well just go to the next one. And that is true when you do a stock comparison, but that is true when you build your entire portfolio. So today I was just happy to show that while the Canadian market sometimes is a bit less diversified and underperforming the US one, we can still find amazing companies that can fight head to head against their US equivalent without being shy of standing up here.
Mm-hmm. Well, thank you, Mike. I had lots of fun today, especially with the Alimentation-Couche-Tard battle. Listeners, know the fundamentals that you want to focus on in order to select the best equities for you. For a good starting point, download the Dividend Rockstar list at thedividendguyblog.com/rockstar. For the show notes and related content, visit thedividendguyblog.com/189. If you enjoyed this show, thank us by hitting that subscribe button, then turn notifications on and leave us a 5-star rating. Until next week, stay invested.
Hey fellow investors, it's Mike here. I hope that you have enjoyed this episode. Please note that the Dividend Guy Blog podcast is at no time issuing buy or sell recommendation. Please do your own due diligence as this podcast is recorded for information and hopefully fun purposes only. Make your research, make sure you do your stuff. We're not responsible for your losses or your profit after listening to this episode. And until next one, stay invested.